your turn now.
Okay, let me thank you, Tirta, and let me put on my screen share so that those attending can follow my presentation. Stop. Okay, can everyone see that?
Very clear, thank you.
Okay, wonderful. All right, well, thank you again, and I will try to go through these slides in an expeditious way, but also to highlight the key points that I'm going to be talking about today, and that is investing in distressed real estate, particularly in this current situation where globally we've been put in a 5-month forced coma around the world, and we still don't know what the ramifications are going to be once we get out of this situation and for how long it will last. Just a brief plug for what we do at Penida Capital. We are an execution management and investment advisory firm focused on the strategic deployment of capital benefiting opportunities in Indonesia and the US. We help our clients meet their equity and mezzanine recapitalizations or loan sales objectives in this current environment. And we've been around for 27 years. And we, again, do our best to help our borrowers looking to recapitalize their existing assets and lenders seeking to dispose of their non-performing loans. What I would like to cover with you today are really just 4 key points. As you can see there, market overview of what's taking place in the market, particularly with private equity and its push for real estate, and the key drivers for investing in this distressed real estate asset class. And finally, what our approach at Penida Capital is when we look at this market. This is a graphic of the US market. And the reason I use it is because, as many of the listeners and attendees know, there's abundance of information on US market. It's somewhat challenging to extract information on Indonesia. There are pockets, but suffice to say that what happens in a market-based, democratically elected economy tends to also have some degree of translation into those principles for Indonesia. What I'd like to share with you on this graph is that the US residential mortgage market is about $2 trillion. And of that, where Penida Capital and we participate is probably 0.03% of our exposure and what we're able to do within this market. So it is quite large, and there is room for many participants and players, particularly looking at non-performing loans or distressed real estate, to participate. Historically, back in the great financial crisis of 2008, 2009, the US saw about a 14% default rate. And that, of course, is above what is typically a 2 to 3% default rate. I would suggest that we could be looking at those numbers or revisiting them again, not necessarily within this calendar year, but certainly in 2021 and going forward. And also could have some impairment in Indonesia, although the residential mortgage market is not as robust as the United States, but it has been growing over the last 20 years. And at any given time, there's about $330 billion of mortgage debt in foreclosure in the United States. We do not see those sums in Indonesia, but again, we will see how things pan out as we proceed through this calendar year. So what has been the impact of COVID on Indonesia? Well, we know that Indonesia expects over 15 million debtors will need to restructure roughly $96 billion of loans due to the current situation. And we know also that the banks have limited resources to deal with these problem loans. And result is that when loans do not get repaid or restructured, we have economic stagnation. And then economic stagnation results in more problem loans. The real estate Indonesia, which represents the developers in Indonesia, roughly around 6,200 members and 52 listed developers on the Indonesian Stock Exchange have put forward in a proactive way what their proposal is for loan restructuring terms with exposures that they have. And I won't go through all of it, but some of them are rational requests. And this is based on my experience, having worked through the 1998 financial crisis in Indonesia, where I was part of a team that managed the top 150 creditors of Indonesia, involving 350 international creditors. Our portfolio at that time was $24 billion of non-performing loans, and Indonesia at that time's total GDP was under 150 billion. Today, Indonesia's GDP is $1 trillion, and so we're looking at a different assessment as to who has the skill sets and understanding, and also case precedent with regards to commercial foreclosures and commercial court proceedings as to what is the recovery rate for those loans. And so putting that all together in a recipe, this particular ask from the developers of Indonesia is not too far off the mark. I'm sure that there'll be continued negotiations as to what that will look like in the end, but suffice to say that what's happening in other key markets, particularly the US, a forbearance clauses on existing homeowners and their mortgages is the right thing to do, and a process whereby those mortgages can be restructured and there is light at the end of the tunnel is also very helpful, because banks are measured on cash flow. And without cash flow, their tier 1 and tier 2 capital will be affected. And so everyone has skin in the game to see this thing through and to get it right, or again, we go back to economic stagnation. I wanted to put this chart up here just to give you an example that not everyone is suffering through this COVID. What this shows is the actual versus expected online retail spending in the United States. And what you will see in the red line at the bottom was the expected online spending. But because of COVID, we actually see a $52 billion increase in online spending. And so what that means is this continually factors into the collapse of brick and mortar retailing, not only the US, but elsewhere in the world. And so that also creates both challenges and opportunities on how do you reconfigure or play in a collapsing brick and mortar retail space. Now, let's go on to private equity real estate landscape. The private debt are also known as private credit investors. These are people who, and investors in private equity funds who lend directly to the real estate sector. They have surpassed over $1 trillion of assets under management this year. Dry powder means they have $300 billion of capital to deploy. And what's interesting about this market, whether you're in a crisis or not, is that the steady returns for the asset class have been proven throughout the decade. And it's performed well during the great financial crisis because institutional investors and high net worth are looking for reliable income streams. The fundraising has been resilient through COVID. There are more funds coming to market than ever before. Distressed fundraising is gaining momentum because the popular strategy for investors is targeting the pandemic playbook. What should we be investing in during this period of time? But the large deals have but it's been declining, and part of that is just because people can't get out and begin to inspect or do their due diligence on opportunities. When we look at private equity investment, this is usually taking a position in the equity side of the real estate, and it also can go through the debt side, acquiring a first lien on a mortgage and also converting that into equity, or paternally on foreclosure where assets are going through the commercial courts for disposal. They have been able to increase their dry powder to $380 billion, looking for a place to invest. And again, the risk profile of real estate to other alternative asset classes the correlation is quite low. So this becomes a very steady component of an investor's portfolio. 2019 was a banner year for private equity. Again, chasing yield, chasing growth, but deal volume has evaporated, down 89% since June. Again, this goes back to the lockdowns and this 5-month forced non-travel coma that we see ourselves in. That will take some time to reignite and get people back into the field with boots on the ground to begin to look at opportunities and deal structures. Properties, particularly industrial, has somewhat been resistant to this pandemic. Where we've seen growth has been in the logistics, data centers, and BTS towers and the cell towers. So these are asset types in the real estate sector that we expect will continue to grow. Now, what do real estate opportunities we look for and the market looks for to invest in? Well, obviously we need meaningful deal volume situated for investors, and that deal flow will also help support the local teams for executions. So when we look at real estate growth in Indonesia, it requires interesting opportunities to invest and to influence growth. We also look at the trends that have increased for both the number of opportunities and the ability to influence. And that is because Indonesia is a market-based democratic economy, and entrepreneurial activity and interest in private equity is on the rise. Indonesia still has open trade and capital flows. And there is a close identification, has been, of family status and wealth with direct ownership of asset, but that is reducing as portfolio wealth becomes an option and allowing for third-party investors and private equity to come in and invest in real estate. There's slow penetration, and certainly there's room to grow for private equity real estate in Indonesia, but the interesting is that the returns are driven more by growth than leverage, and that is less financing and more on the equity side. And we're seeing, again, because of the Indonesian demographics and growth projections, not only Indonesia, but its emerging market linkage with the rest of the 10 economies of ASEAN, as well as the global economy, is increasing. And so in that regards, you will continue to have a bid into the real estate market for Indonesia. Now, I talked about execution, and execution is everything, whether it's Indonesia, the United States, Singapore, or name your country. But you have to have boots on the ground who can properly value, appraise, and determine what are good opportunities in the real estate sector, particularly in the distressed real estate sector, to begin to formulating an offer and to bid on. And you really have three choices. You can run an existing team. Let's say you're an outside private equity investor. You can look at buying a team we call lift out from maybe an existing organization, or you can build a team from scratch. But again, it all focuses on execution. That is not in my backyard. I just use that for reference. So what are the key drivers for investing in distressed real estate? Well, we do know that there's $1 trillion globally, 380 billion of dry powder looking for a home. Investors, again, are attracted from to the reliable income stream. It's an inflation hedge and low correlation to other alternative investment assets. Returns in this sector tend to be somewhere in the neighborhood of 10 to 18%. They certainly can go higher in the 20s, but that is based on the grade of that asset and how much effort and energy and time is needed to rehabilitate that real estate asset to get the returns that you seek. One of the things about real estate is if you control a first lien or have a position over it, in a liquidation or foreclosure, it does protect your losses on the downside, because any liquidation you are repaid first in the queue and others are repaid in a cascading part of the capital structure. Residential funds have performed well over the last 11 years. At 14%, office and industrial has done well, but retail has really been hurt bad. And again, that is a factor of e-commerce and online buying. Distressed asset funds are waiting to take advantage of scenarios once the COVID dust settles and the stimulus programs begin to end. Asset prices will begin to drop. What situation we have right now, is a lack of price discovery simply because of the lack of transactions taking place in the market in order to have comparables of what prices are taking place. We focus and we anticipate we'll start to see more activity and more price discovery where asset prices are by the end of this calendar year and moving in the first and second quarter of 2021. Office and residential distressed assets right now are leading the way. As I mentioned earlier, the growth industries are logistics, data centers, and BTS towers. Retail and malls are collapsing. And something related to Tirta's presentation is that from the peak of real estate to its trough is roughly a 6-year cycle. So within Tirta's analysis, somewhere around 2014, 2015, if we looked in Indonesia as a peak, then we're looking at the trough somewhere in 2021. And I think that's something that we should all be cognizant of. Now, again, key drivers, as I mentioned, with your private equity and distressed real estate. We call this direct lending. Sometimes it's called hard money lending. But what my experience has been, we call it asset-based lending. You have an asset, you lend against it, it's collateralized. Banks lend against cash flow. And this is where we have a challenge with their position, simply because if they are not generating cash flow from those mortgage loans being serviced, they are in a difficult bind and they have to look at either restructuring that or writing it down and disposing of it. The alternative investors provide bridge loans in this area, and they'll either take a first lien position that's first in the queue to be repaid and first in the queue on the collateral being pledged. And generally they will look at a 12 to 20 month term loan. In many ways, to borrowers, asset-based lending from real estate investors can be seen as a Robin Hood for the borrower. Now, our approach to this segment. We are focusing on a very specific niche of the non-performing loan space, and that is we look at the 5 to 15 million trade space where there is less competition among the big private equity players in the universe. The market only gets better as volatility increases, and this is an industry, regardless of economic conditions. Volatility enters our market. We are well positioned to take advantage of both downturns in real estate values as well as liquidity freezes. And direct investment with established business structure. We've been doing this for quite some time. We have partners and relationships around the world to service those markets for our investors, and we provide boots on the ground for those seeking opportunities in Indonesia. Again, going over our approach, our strategy is very simple. Again, buying low, fixing up, and selling quickly. Non-performing loans, we are able to provide immediate liquidity to those looking to invest, and for banks who are looking to sell down those positions. When we look at foreclosures through the commercial and judicial courts take a long time. On average, you can see the days versus if you have an execution team that can work with existing borrowers of both residential and commercial properties, you can reduce the resolution by a significant portion. The assets we look to acquire, again, we're looking at anywhere from 40 to 7% of the collateral value, and we have an internal system of evaluating what that collateral is. There are a number of cost components that go in, particularly maintenance costs, the carrying costs of that, to continue to carry on holding that asset until we feel that it's an appropriate time to sell it into the market. Our structure is very simple, and that is we're either doing this as an advisory fee, or we're taking actually title or a first lien position of the real estate asset itself. And our focus is really where we can get the best discounts on non-performing loans and where we have boots on the ground. This is a diagram of the process that we go through in scrubbing opportunities and getting them into our portfolio to manage and to generate returns for ourselves and our investors. It is not as easy as many people think. There's a lot of work that goes on, particularly in the asset. Once you've sourced the asset, the most critical aspect is determining what is the collateral value and bidding on that. And then, of course, closing and servicing that. And we use other service providers who are best in breed with regards to servicing that. But bottom line is we want the original owner of those assets to stay within, whether it's their residence or their commercial properties, because getting them to perform makes a lot more sense than dragging out a prolonged restructuring or foreclosure process. A typical portfolio is, for example, let's say we have a $200 million portfolio and we'll label this as A paper and high value assets. This simply means that this is high grade based on our scoring and our valuation. And in a typical portfolio, you'll see let's say 1,800 different loans. The average holding period for us would be 419 days, and average price would be about 200,000. Now, the return on investment is still quite good, but when you compare that to when you start to get into the lower grade real estate, you can take a 2.5 million portfolio to mitigate your exposure, and now we're talking about B, C, and D, and that's just a rating as to what is this real estate, the collateral we have apportioned it, is it a true fix-up, and the likes. But in of that, you can see very high rates of return, in north of 35%. Thank you very much for your time on this.
Thank you very much, Edward, for your insight. Edward is a very good friend of mine, so I always trust his advice and expertise, even his apa ya namanya, what he says is very true, and Edward always give the big picture and always give the solution. So so yeah, next will be Mr. Dian Parhulutan. Please, the floor is yours. Just to remind, please enable the apa ya namanya? Nicholas, what's the name for the macro enabled?
Participants annotation.
Yes, please itu apa? Participant annotation or not? There will be some writing in the presentation.